afternoon, everyone. My name is Marc Cabrera. I serve as an investment banker in Oppenheimer's Healthcare Investment Banking Group. Just a very short intro to our practice. 85% of the clients that we work with are what we call founder-owned or partner-owned businesses. They are first-time entrants into the institutional market today, given the amount of activity that is taking place in the physician sector, broadly speaking. A lot of our work happens to be in this space. So we're representing sellers who are essentially exploring alternatives for their practices or their physician organizations. So my topic today is really the type of presentation I would cover with physicians who are thinking about what should they be doing in an environment like this. Just a little bit about the physician market, the labor pool. Some of these are stats I think are relevant to bear in mind. They're things that physicians may be aware of or may not be aware of. We try to synthesize some of this data for them to understand what are some of the macro, really large demographic trends that are driving consolidation in the physician sector today. And then we try to tease it down to their level, whether it's their geography or their practice or their specialty. But physicians still a very significant component of the healthcare spend. Roughly 20%, close to $700 billion of spend. You can see, if you go back to 1960, the level of spend has gradually slowed. That's probably similar, of course, to all the major slices of the pie. Roughly 900,000 active physicians today. The largest category is primary care, family practice, followed by emergency medicine, anesthesiology, some of the hospital-based specialties, and then followed again by the office-based specialties. You'll see physicians in patient care per 10,000 per capita. You see how that started to flatten. That's had some significant impact in terms of physician burnout, physicians working harder but not necessarily making more money. Definite pressure on physician comp. This is certainly something that most physicians that we talk to complain about. They may be working much harder. The practice itself may be growing. The revenue base may be growing, but they don't feel like their compensation is actually keeping up. On top of that, many physicians definitely suffering from some level of burnout. They're getting it from a number of different directions. They're getting it internally in terms of increased administrative duties, lots of new programs to deal with. So you'll see some of the stats here, but it's certainly something that is, I think, driving different generations of physicians to think about how they're practicing medicine and how they want their particular practice to operate. I think one of the most significant things, and I think this is a macro trend that a lot of investors are focused on, is the fact that depending on the specialty and the geography, there are massive shortages developing in the labor pool. And so if you can aggregate a certain geography or a certain specialty, there is value that's created that way, in part because you own a piece of real estate at that point. You'll see back in 2010, roughly 25% of the total physician pool were age 60. Just 6 years later, that's now 30%. So this is a pool that's aging, and we don't have enough grads coming out of med school that are essentially backfilling the attrition that's happening through retirement. So what's driving consolidation? I think fundamentally one of the things that's driving consolidation today, you've got to look at some of the large demographic trends. Today, graying of America, we are right at the front end of a very significant bump up in the number of enrollees in the Medicare program. I know there's discussion already this far ahead of the election around Medicare for all. It's had an impact on some of the managed care stocks. The reality is whether you keep Medicare Advantage and fee-for-service, Medicare Advantage today is taking dramatic share from fee-for-service. It's largely working, and it's largely got bipartisan support, but that's going to drive a lot of payment models going forward. The other big government program today that's growing is Medicaid. The ACA drove a lot of Medicaid growth, especially in the managed Medicaid realm. We see that continuing. and you'll see this, just in short 10 years, the government share of insurance has grown from about 39% in 2013 to over 50% within the next few years. So as the population grows and the dollars remain relatively the same, but you've got more insurance coverage, and you compare where physicians sit in the delivery chain, and you compare them to other big sectors like hospitals, the pharmacy sector, most other large sectors have been consolidated. The 3 largest commercial health plans control 50% of all lives in the country. The 3 largest PBMs manage 3/4 of the lives, or the claims, I should say. The 3 largest pharmacy chains represent roughly 60% of industry revenue. And in most MSAs, you've got 1 or 2 health systems that dominate those markets. There are very few MSAs where you've got really 3 or more major systems that dominate a market. On top of that, you have the payers themselves, differing strategies, but essentially investing either aggressively or tangentially in the provider network. Physicians, however, as large as a group it is and as large as the pie of the spend, are largely unconsolidated when you really think about it. Today, only 15% of practices have 50 or more providers. And I know in terms of when I look at the average deals that are coming to market, whether it's with us or other investment banks, a large practice might be 10 physicians, 20. Certainly if you're in the 50 to 100 range, that's a large practice. By comparison, if you think about the revenue of those businesses, they're still tiny businesses when compared to the plans and the PBMs and the large other consolidated sectors. If you look at PPM penetration in some of the key specialties, I think this point was made in one of the presentations earlier, you've already seen a lot of consolidation in the hospital-based specialties, so you see emergency medicine, anesthesiology, radiologies. There was some consolidation starting to pick back up. And then down at the bottom of the page, we're missing dental here, but if you look at derm, orthopedics, these are largely unconsolidated sectors. And that's despite a fair amount of activity in a lot of these sectors in the last few years. Hospital consolidation is also driving integration, physician integration. This is especially happening in primary care in a lot of MSAs. But we're also seeing it in some of the specialties like GI and ortho. On top of all the consolidation, you've got all the pressures that physicians are dealing with around changing payment models. A lot of pressure from the largest payers themselves to shift to pay for value. You'll see most practices are still largely fee for service. You've got a lot of physicians dipping their toe into downside risk, but it is still very, very much in early days when you look at the entire U.S. Large opportunity in the primary care market, and I think there's derivative opportunities in certain specialties to participate in a profit pool that exists today, but is largely being, I would say, just sort of waded into carefully, which is, this massive shift to pay for value. There's lots of approaches and lots of models that are trying to attack this. It is a large untapped profit pool today. So what does this all mean for strategic alternatives? We would say there may be 6 alternatives. I would say the reality is for 95% of the physician practices out there, they may only really have 1 or 2 of these alternatives that are available to them. On the far left, stay independent or maybe merge with another practice in a stock merger to gain some scale and some economies across the administrative expense side. That does, to some extent, maintain the status quo. I don't personally think that that's a smart strategy in this market. I think you either need to be part of someone else's growth plan or you need to have your own. The next one to the right, minority investment. That's not the typical, I would say, middle market private equity model today. Most of the models are fairly conventional around a majority recap. But those are alternatives, and a number of larger groups that we're talking to, they may have had experiences back in the 90s of being partnered with a PPM. They still remember it. They want to wade their toe into the institutional equity market, so they want to talk about what alternatives exist in terms of minority investment. And interestingly, I think a lot of those discussions really revolve around really good alignment. They want to use that capital not necessarily to engineer the financial transaction of taking chips off the table, but they're looking for capital partners to help apply some discipline and financial structure around some investment opportunities. The next one, let's say consolidation or recapitalization with a private equity firm. The reality is that's not really available to most practices. That's available to the larger, more developed, more mature practices that hopefully have either developed their own back office and need it to be tweaked, or they have the capability and the cultural willingness to do that, and they're looking for that experienced partnership with a private equity firm that's done it a few times and can add that level of value. Depending on what market and what specialty, there are practices that may be of scale but don't meet those other criteria, and they're good candidates for an add-on to a private equity recap platform. Sale to hospital or local health system. Generally, when we talk to practices across specialties and across the country, that tends to be the least attractive alternative. They view that as a last option. There is security in it, but I think that physicians are savvy enough to have either talked to others that have done it, and the reviews are generally mixed about what life is like working for a health system. And then lastly, sale to a strategic. What does that look like? It depends on the specialty. In the hospital-based specialties, there are lot of previously publicly traded companies like Team Health and Envision that have been active, consistent acquirers of large practices. In the office-based specialties, we don't really have any natural publicly traded acquirers today. I think we might see, depending on what happens with the equity markets and the economy, you may see that as an eventual outcome, but you're starting to see some practices that have gotten to scale where they could go public, but for whatever reason, most large platforms are still exploring full exits via an auction process. In terms of the way we look at the market, we look at office-based specialties, hospital-based specialties, and then primary care as a separate bucket. In office-based specialties, there's been consolidation going on really for the last decade. I think it's heated up in a couple of new specialties more recently. The reality is, if you look at the penetration of the PPMs in the office-based market, we're still very much in early days of consolidation. Dental has probably seen the largest number of platforms capitalized by private equity, followed by dermatology and ophthalmology. More recently, let's say in the last 24 to 36 months, you've seen a lot of capital formation, private equity capital formation in women's health, in gastro, orthopedics, urology. But if you look at, let's say, our data is 9 years of transaction activity for platforms. This excludes tuck-ins, but roughly 100 platforms created across these specialties, only 12 exits in that time. And the average hold time so far across all those is about 30 months. So we're still in relatively early days. In primary care, again, I think the consolidation is more mature, but primarily because hospitals and a lot of smaller MSAs have been quietly at work consolidating primary care and family care referral sources for their local systems. In some of the bigger seniors markets like California, Texas, New York, Florida, there's been a more recent wave of private equity capitalization of some of the at-risk models, some of the IPAs in California. So that market seems to be, again, increasing consistent with the interest in the office-based specialties. What's different today compared to the 90s? The short answer is maybe everything. The payer market's completely consolidated. Payers are looking to drive providers across all specialties into some type of risk arrangement. The technology offering today is completely different. It was virtually non-existent back in the 90s. The administrative, let's say, opportunity to create efficiency, I think, is much more significant. And I think to the credit of both the practices that are actually partnering with investors and investors, they're just being smarter about it today. There's, I think, a lot more alignment in the models that we've seen. There's a lot more focus, either by staying geographically focused, staying focused on a particular specialty. The last version of this back in the 90s was largely an arbitrage opportunity between the private markets and the public markets. At the peak, there were almost 40 publicly traded PBMs. Today, there's really only one left, which is Mednax. The others, Envision, Team, have gone private. So a lot more of the work that's being done, and I think someone made a comment that there's a lot of work that gets done in the lower mid-market and the mid-market, and I think that's true. I think that's where the real value creation takes place. A lot of that's happening appropriately in the private market today. So I think the conclusion for physicians is, look, there's lots of alternatives. It's always case specific, but the one thing that we counsel today is, while we're very much in early days of the consolidation, and there's a lot that really is just unknown still today. It is a very different time than it was in the 90s, and whether you're a small group or a large group, you should be having this conversation at your board meeting. And as you probably all know, if you're investing in this space, you're advising in this space, a lot of these conversations take place after office hours, over dinner, or on the weekend, or once a year at an annual retreat. This is not a conversation that's happening by any stretch of the imagination on a daily basis. And so it's a lot for folks to absorb. And I think our experience is a lot of physician groups are essentially gathering this type of information anecdotally and sporadically. They're meeting with private equity funds, they're meeting with bankers, they're meeting with executives. They're not necessarily very disciplined about it. So that is part of the opportunity that we see, is just the level of organization that is being devoted to helping this consolidation be successful. That's it. In terms of the presentation, I'm happy to take questions.
Mark, are you able to give us an example, a specific example of a consolidation where you think it worked out particularly well, and maybe why? And similarly, can you point to a specific consolidation roll-up that did not work well on the other end of the spectrum, and maybe observations as to why you think it failed?
I think there are a number of consolidation efforts today, and I think it depends on how you measure success, right? If you're a private equity investor, generally you're being measured on IRR and return on invested capital. I think a lot of the platforms today, if you were mark them to market at current multiples, a lot of them that have been in the business for the last 2 years of actually consolidating smaller practices, integrating those practices and building out the infrastructure, I think there are probably more successes today than not. But for example, Audex was one of the first investors in GI. I think that platform's doing really well. And I think if you're honest about the level of investment that's required to really build an institutional infrastructure it's a J curve, right? You're investing early on after you buy the platform because a lot of these even larger practices don't really have the adequate infrastructure. They don't have business analytics that you really need to be able to get the value-based contracts with payers and do the acquisition analytics and integration. So I think a lot of them that are already a bit more mature are doing well. It's green pastures. The playing field is pretty wide open. I think the bulk of these platforms, it's still too early to tell. It's just we're too early in the investment cycle. I think pointing to someone that has, let's say, a case study of where it hasn't worked, it's tough. I can't think of someone today. I think we're familiar with, let's say, one asset in the primary care market that grew very aggressively through acquisition. They did that through earnouts. They did that using a lot of leverage. They did not integrate, and that entity today is struggling. They're over-leveraged. They haven't generated any of the economies of scale that should exist in a business of that size. And I'm talking about a business that's a couple $100 million in revenue. And I think, today, that's the worst case scenario is, you don't really execute the way you're supposed to with these types of business models. I think if you look at the failures from the 90s, they're very different set of reasons why those entities failed. Great, thanks everyone. Appreciate the opportunity to speak to you.